Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. I'm muted, of course. Yeah, I am late. I don't know why I'm late. I don't have an excuse today. I've been getting worse and worse with that lately, haven't I? Anyways, we got the Federal Reserve meeting today. I thought because it was kind of tight yesterday that we would have a little bit of trouble today, but the treasuries are moving now. So let's come over to the charts, take a look at what's going around, see if we can sort through maybe some of the news here. So in ZN yesterday, there was some decent movement overnight, but then when we came into the regular session, it got pretty tight. Treasuries didn't move much of anywhere, and it's been even tighter overnight. S&P 500, quite a choppy day yesterday, but we had a ton of tech earnings, and that's why you have all of this volatile movement here towards the end of the day. But in the end, here this morning, we are a little bit lower. Oil, again, oil having a little bit of a drive yesterday, but then in the after hours, that was kind of cut down. Coming to gold and silver actually having a little bit of a run here. That despite the treasuries still being somewhat aggressive. So that's good for gold, I guess. And then you got copper having a good day yesterday, giving some of it back this morning. And then we come back to the currencies. Well, cryptocurrency not doing so hot, but they are trying to claw back from this huge sell that they had. And then you've got Bitcoin here. Or sorry, the dollar. You got the dollar kind of, it's a little bit lower today. But I'd still say that anywhere above 100.5 is still relatively strong. You know, and it could, because we were below 100. Like what? Earlier this week or last week or something like that. So okay, so the treasuries look like they've chilled out. And it kind of looks to me like the move is just starting from when we opened. That is just the stuff going on from the regular session open, but wow, Kevin McCarthy tweeting about the sound of freedom. That's interesting. Are you mentally, physically? No. I mean, I tend to as of late, I've been avoiding trading on FOMC day, right? It could happen. It could still happen. But FOMC day is just like super dangerous, right? Because you get so much flow and a lot of it is really just nonsensical. Wow, that was some aggressive 2 upticks there in the treasury. But you learn a lot on FOMC day, right? So I've kind of come to the conclusion that FOMC day is for watching and learning, right? But I really want to know what's going on here. I mean, at the bottom of the hour, we didn't have any significant economic releases or anything. We did get Coca-Cola and AT&T earnings calls, is showing up on my calendar here. It's kind of weird. I don't see anything on Twitter except for that Twitter changed to the stupid X logo. Dude, I think that the Elon Musk's whole plan there is kind of dumb. So you know what? I kind of looked into this because I'm like, I think this is so dumb. And I go around and you know what? There are a lot of people that think this rebrand is dumb. And I'm like, well, you know, especially on social media, Elon Musk has become kind of hated and there's a lot of politics involved. So I'm probably not getting a very clear picture. So what could I do to try and look to try and find commentary online that would contradict my own and say like, actually, this is brilliant. And here, you know, here's all this stuff, right? I know. Let's go to the Elon Musk subreddit. Like we got to go to a place where like the people worship him, right? And so I go on to the Elon Musk subreddit and all of the comments on the thread about it are like, you know, I've been a fan for a long time. I've owned Teslas for this many years, etc., but I don't get this move. I think it's dumb too. So it seems like the whole world agrees that the X rebrand isn't a very good idea. We like the birds. I think the bird is cute. Like if you're gonna rename it, you should sell the brand. Like you should sell the brand name because we like the cute birds. Anyways, I don't see anything. Very interesting comment from Nassim Taleb. The more inequality in a society, the fewer people you can envy. Flatter societies, but not 100% flat, produce more envy. Most people get this backwards from the counterintuitive effect of fat tails. When the Gini rises, the wealth is more concentrated among fewer people. Yeah, but isn't that like overall a bad thing? Because if there's lots of people for you to envy, it's kind of like oh, well, whatever, that's the way the society works. But when it's like a very few number of people, it makes it very, very easy for you to just villainize them, right? Like if a politician comes out and attacks the middle class, let's just say that the middle class is taking too much money compared to the working class or something like that, and they can turn them against each other, and right? But then there's going to be all these people in the middle class that are going to be like, well, hey, hold on a second. Here's the way that the situation actually is for me, right? And there'd be lots of people saying that. And so then you get to understand each other and you kind of sort things out and whatever, right? But when it's just like a few billionaires out there, right? You can just say whatever awful thing you want to about them, and it doesn't really matter what the billionaires say. Like they can't defend themselves because there's just one person against the horde. Is this enough information? Well, but you can't short Twitter. It's not a publicly listed security, right? You could potentially turn that into a proxy trade and try and short Tesla. I shouldn't have said that. Okay, let's look at it. What is better, NinjaTrader or Sierra Charts? Ooh, that's a tough call. I think so. When it comes to any trading software, the first thing that you have to kind of realize is that every platform is well adjusted to a specific thing, right? So, because a really competitive market leads to a lot of specialization. Okay, I was seeing this. I've been looking at a lot of watches, right? there's a lot of specialization in the watch market. Actually, there's some makers that specialize in making really cheap watches. There are some people that specialize in making diving watches, and there's all types of watches: dive watches, field watches, digital watches. And if you're a new company, because there's a lot of watchmaking companies, apparently it must be a very high margin business. You kind of pick a niche, and the futures market is very much like that. So, for instance, if I was primarily going to try and program things and make my own indicators and backtests and stuff like that, I would go with NinjaTrader. Of course, you can do that in Sierra charts. It's C++, so it's a little bit more difficult to write, but let's just say that you know C++, right? I would probably want to go over to NinjaTrader because NinjaTrader just has a much more rich ecosystem. There's a lot more stuff for you to work with. It has a much better facilities for backtesting, things like that. And so NinjaTrader has a huge leg up on the competition in that particular respect, right? If you want to get all of the different types of charts, you want footprint charts, and you want volume profile charts, and all of these things, and you want it cheap, right? Because if you want that from NinjaTrader, you have to pay for the license, which is not cheap. But for Sierra charts, you just have to pay the monthly fee, okay? Which after everything comes out ends up being like 70. No. It ends up, it's like $30 or something like that, right? And then plus the data and everything else. But that's kind of the advantage of Sierra charts, is you get a very full package without an upfront payment, right? So that maybe will so what you have to do is you have to look at what are my specific needs, right? Now on the split side, if your need is the DOM, you're going to be trading primarily from the DOM, right? Well, Sierra charts is better than NinjaTrader, but I would say that Jigsaw is better than Sierra charts in that respect, right? And if you're a hedge fund and you're running a CTA or something, you'd probably want to look at the professional packages like Trading Technologies. Okay, so what we wanted to look at here was Tesla. Interesting. So, what I wanted to see on Tesla. So I remember being up in here and talking about shorting it and actually doing it on a sim account and just holding it, right? So obviously that one worked out. So now, to today, right? Well, how well has Tesla followed this whole rally here this year? Well, it's had periods of struggle, but during this whole May, June, July time period, they have risen with the rest of the bull, right? Okay, so if I was to go short on Tesla, I think from a relative value perspective, so the theory would be Elon Musk will have to sell some of his Tesla stock in order to continue with what he's doing with Twitter, because Twitter is not making money right now. Twitter is not making money as far as we know. They were making a little bit of money, but now they are revenue negative. So he will probably have to sell some Tesla, and that would hurt the stock price, right? You could trade off of that thesis. The biggest risk to that thesis is that the rest of the market continues to be bullish and Tesla rises with it. So I think if I was going to short Tesla, I would want to hedge it. I would want to be short Tesla and then long a car company. Let's say Ford. Ford is doing pretty good right now, right? Ford or Toyota. But I'd say probably Ford, because Ford has a pretty good EV space, and really what you want is the exposure to the EV, right? And then I think I would also add onto it like a tech, because Tesla, I think, kind of trades a little bit more like a tech in some respects. So maybe you could go long something like Nvidia, although Nvidia is super rich right now too, so that one makes me a little nervous. You could try the value play and try Intel, but nah, I think that the Jigsaw DOM is better than Sierra charts. You're not paying too much more for it, first of all, to be frank. And I think the big advantage that you get with Jigsaw is you have a developer that is really deeply engaged in the trading and really understands it and has like a unified vision for how to trade and make tools that will be useful to people. And Sierra Charts is kind of like steal features from everybody else and just smash it into a package. And the way that they, what you end up with is a package that doesn't really make a whole lot of sense from an organization perspective, right? So, and I think that Jigsaw continues to work on features that will be, important, will be useful, right? So I don't think that in the long run, Sierra Charts to keep up with you. But it has been a while since NinjaTrader did a release, hasn't it? What data? I am using Rhythmic for my data feed. So the reason I use Rhythmic is because you get this Rhythmic Trader Pro thing, and that allows you to forward the data to multiple applications. And so I'm allowed to use Jigsaw and NinjaTrader at the same time, right? And at some point in the future, I think that I use, maybe I use Jigsaw and my own quant platform, right? But, to avoid the professional fees and like having to connect multiple times and stuff like that, I think that Rhythmic has the best setup for that right now. Okay, I think I said everything that I need to about Tesla, right? Could go short it. I would probably hedge to short. Oh wow, we're back to 3861, huh? So I still don't have any information on like what is driving the treasury market. I should say that this move overall, we started at negative 3,600 cumulative delta, and we're now at 31,000, negative 31,000. So it's only a net 5,000 difference. I am seeing a little bit of a decline in the dollar. So one could argue it is the Japanese yen again. I'm not really seeing gold and silver move along with it either. That's kind of curious to me. But so far, I don't see any evidence to suggest that it is actually a news-driven move. I am starting to see some things that could suggest that we get stuck and that the action changes here a little bit. Is traders trading? I don't know. I mean, if it was just usual trade though, I wouldn't expect them to have gotten as far as they have. But it did do like a head fake. Like it opened lower initially, and then they bought it. So I guess the other thing that you could say is that probably there is a large meta order behind this. Well, look at that. They just as I'm thinking that they're starting to get stuck, they decide to push further. It's quite aggressive too, I must say. Like those bids stack up behind it real quick. And the bids are clearly stronger than the offers, right? Maybe somebody is just placing a bet that, you know, the rise in rates that we saw this week isn't going to hold on the FOMC. The main risk for a reflattening of this curve at today's Fed meeting would be an indication they have several more rate hikes to go. But nothing new from that point. Man, the new Twitter logo is really throwing me off because I'll look at something and then I'm like, okay, I need to switch it back over to Twitter. And then I'm like, where is Twitter? Oh, that's right. It's that stupid X. I associate X with closing a window. It's dumb. It really is dumb. You really did. It really is taking like what is possibly the strongest branding in the world. And when I say strongest branding, I mean like logo and name and thing that people are familiar with, right? And just throwing it away for something that I really don't think works for what he's doing. So like he said, that Twitter doesn't fit the everything app thing that he's trying to do, but X does fit it in terms of like X can be anything, but it's not a strong brand. It's cold. It's you know, X has no empathy. X doesn't give a crap about you. Like, your little Twitter bird says cute. Like, people can relate to that, right? You can't relate to an X. It just doesn't. It's just not a good move. It's a kind of a move that I feel like would come from somebody that doesn't really understand branding. You know? You're 2x, 2 steps away from meaning something to no one. Yeah, and then the other issue is that he wants it to be an everything app. So that would certainly be like that you have a video platform. So then it's going to be X videos, and that's already like a website. So like, he has WeChat plans. Yeah, that is. Yeah, and that's kind of, so this is my other issue, okay? Arguably, he only knows marketing. No, he only knows publicity. Publicity and marketing are two slightly different things, right? He knows how to generate interest and news stories, right? But I would argue that he does not know how to build a brand. And in fact, I think you can see that very clearly with Tesla. So like the Tesla as a brand is just not working. They are not a car company that is known for quality, right? Like the whole thing that the car enthusiasts have been saying this whole time is that, like, I know you're all excited about them being full EV cars and everything, but these are really poorly made, right? I don't know how he's the richest person. Well, because the reality is he's not the richest person in the world. So, do we really want to dive into this? Public relations. Yeah, he knows public relations, publicity, yeah. But not necessarily brand. Right? Because brand is more like how do people feel about your company? How the people, what kind of people are attracted to your company? Like people identify a certain way and they have certain interests. And why does that interest attract them to your brand? Right? Like what is Seth's brand? Seth's brand is excellence, integrity, and teamwork. So the people that are going to come and want to watch this stream are the people that they're trading and they want to do the most excellent trading. So they're looking for a leg up on the competition. They're looking for information that the rest of the trading world seems to be missing. So you come to this channel and you see, oh, here's all of this quantitative research that the trading world for some reason has ignored for 30 years, right? The integrity. Do you have somebody that I'm going to come out, I'm going to show you all of my data, I'm going to give you the indicators and everything so that you can backtest these things. I'm going to give you the research so that you can prove these things for yourself. And I'm not interested in promoting my course the most and seeing how hard I can shill the thing. I do have affiliate links and stuff, but that's from the software that I use and that I think works best for my particular use case, right? And then teamwork, which is we get here on the stream and we're working together to trading, right? That is the brand, and those are the things that we're, the people that we're trying to attract in, right? That's branding, right? And when you look at Tesla, it kind of attracted a certain type of person because it was an EV thing. And like they're kind of losing what they had and squandering it because the quality wasn't there. That it just and I think that a lot of Elon Musk actions just aren't in line with the brand that they need, right? He turned into just like Donald Trump, right? Where because does Donald Trump have a strong brand? I mean, because his brand is basically known for drama. It's known for having lots of drama, being rich and having lots of drama. And that's kind of what Elon Musk's brand is turning into, right? And that's not necessarily a positive brand. Nope, hold on. Forgot to turn off my speakers. I think Elon is used to being a contrarian, so he won't care about... Well, yeah, for sure. But like the deeper problem that I see here is it's like the way that Elon functions is he has a set idea and he's like, I think that things should be this way, and then he comes in and he makes it happen. So he says, I think that we should have electric vehicles. So he makes a car company that makes electric vehicles more accessible to people. Okay. Well, you know what? Like when that all started, way back, like what, 2008 is when I would say was kind of like the time frame when this stuff kind of mattered, right? We did think that was the case, right? But then what happened was electric vehicles became a bigger thing. And then we realized all of the things in the supply chain that were leading to electrical vehicles. And now we're kind of questioning whether they're actually worth it and whether they're helping, because we can't support it with our electrical grid. And it requires rare earth minerals that are very difficult to ethically obtain right now. Right? Okay. Elon Musk decides that we should live on Mars. Okay. Well, I don't know how that one turns out, but it's one person imposing his ideas on the world, right? And that works. I mean, having like a singular vision is like a very valuable and useful thing in certain domains, right? But the problem that you're getting is that then you think that you know everything and I can go and apply this to anything in the world, and he's applying it to something where I just don't think it's working. I just don't think that the vision that he has here for this thing is a good one, right? Because it's not just like I don't want one app that does everything. I don't. I want one app that allows me to talk to the world and keep track of what's going on live in the world, and I want another app that is for communicating with my friends and close people, friends and family, right? That's the way that we had things separated out. There was Twitter and there was Facebook. To me, they don't compete. Even though Facebook tried to impede on Twitter's kind of domain, right? I don't want payments like my wallet to be tied up with my Twitter account. Don't. They should, like, my money should be a completely separate thing that is, you know, because what happens if you like get banned from Twitter, then you lose your wallet, like, you know? This is silly. I don't want my video platform attached to my Twitter either. I mean, I may end up putting videos on whatever platform he makes, or if he's doing live stream, I may end up doing dual streaming or streaming on his app. Sure, because it might give me more discoverability, right? But I don't necessarily want like my Twitter communication thing tied up with my YouTube, because it just introduces contagion risks, you know? So I'm not even in on, and then on top of that, I really just don't want a corporation with that much power. I really, really don't want a corporation with that much power. It's just like Uzi saying, the China model, right? I don't want it's the China model, except for that it's a corporation, so it's okay. No. We don't want that. We don't want that at all. So it was like, so kind of where I'm getting at is that, like, what I was sold in terms of Elon Musk taking over Twitter, which was that he would fix Twitter so that it could be an open platform again. Well, not that Twitter was ever a truly open platform, but it could be more open and kind of more the vision that Twitter was supposed to be, right? I was totally on board for that, right? But then let's turn it into some sort of dystopian everything application? No, screw that. What's this link you got here? New Toyota's electric car has a solid state battery. Oh, they're just unveiling plans for it. Could be. But hasn't Toyota has kind of been a little bit like not completely on the EV wagon though, right? It's like they've been investing in technology, but they keep saying like, we think that it's going to be more complicated than that. I seem to agree, but you know, there's this other thing, which is like, you see that like the Biden administration plans are basically like some of the regulations that they're proposing will get rid of all kind of gas powered generators and stuff like that. And it's like, they don't want you to use natural gas stoves, right? So like natural gas is another energy source that you can run cars on today, by the way, that is a clean source of energy and is much more efficient, in my opinion. And it's much easier for us to transition to, right? But that's not what got the government subsidies, right? And now it looks like the Biden administration is going to kill it. Yeah, Toyota is into hydrogen. This is like Toyota and Hyundai are like doing hydrogen stuff. So, anyways. I felt like there was another point that I wanted to make here, but I think I made all of my points. I don't know. I've kind of got, because I remember there was a point, and it wasn't that long ago, but there was a point a couple of years ago where it was like, well, you know, I think it was around the time that the Cybertruck was released, actually. I think there was a time around when the Cybertruck was released that I was like, you know, my next car, maybe it should be an electric vehicle, because I'm, you know, I don't want to have to pay for gas, and I'm afraid that the price of gas is going to go up too much, right? But like then, like two things happened. was one, the pandemic came along and I just don't drive into work anymore. So I don't really have the need for a really tough workhorse vehicle that can drive 20 miles every day. And then all of this stuff with the EV market has happened where I'm understanding the problems with rare earth minerals. I'm understanding the problems with the electric grid and so forth. And so now I've come back to, yeah, I don't want an electric vehicle. Because I see all these people on YouTube that are like, you know, or not just on YouTube, but like in general, like they get rich. You know what I mean? They get to where they want to be financially, where they feel like they can kind of spend on some of their real desires, you know? And one of the first things that they do, like Graham Stephan, is they go and get an electric vehicle, right? And I'm like, no, not me. I'm going to drive the car that I have to the ground until it literally just does not work anymore and it does not make sense to buy it anymore. And then I'm going to buy a really fuel efficient vehicle or a truck. I'm going to buy something that matches my current use case and needs the best. And I'm not going to care about the electric vehicle stuff. They want everything electric so they can control your life. Okay, so this conspiracy theory doesn't make sense to me, to be honest with you, Brad. So there's this idea that like they want you on an electric vehicle because then if they want it so that you can't drive, they can just turn it off. They can say, oh, we're using too much carbon this week, so you're not allowed to drive your car, right? And so then we just kind of turn it off because it's electric, right? Well, first of all, like these cars all have computer chips and all of that sort of a thing. So if you wanted to turn off somebody's car, like a gas car, they could do that. If they wanted to build that stuff into the car, they could do it with a gas car, right? And you might say, well, yeah, but you should still be able to like bypass it, right? Well, first of all, no, because the electronics of these cars are such a major part of the car, right? Like you can't repair the car yourself. You can't, it requires the electronics to work. So if they can lock the electronics, yeah, you're not using the car. And then vice versa, if you are able to bypass it, well, you can bypass it with the electric car too, because there's, you know, they are still separate units. There's the brain part and there's the electric vehicle part, and you could just bypass that. So I don't think that particular conspiracy theory makes sense. That's the reason why we're pushing electric vehicles. No, I think that what happened was that electric vehicles kind of came in first to the scene in terms of we have a solution, and then the politicians gave them money, and that's really what it all comes down to. And once an industry starts to get money from the government, right, then you basically get regulatory capture, right? So it's we essentially, the electric vehicle market has successfully performed regulatory capture on the government. That's what CBDCs are for too. Well, now CBDCs are a different issue, right? CBDCs could absolutely be used for dystopian levels of control over the financial system, right? Although one could kind of argue that we already kind of have some dystopia. You know, like when, what was it, Nigel Farage got kicked out of his bank account. Like that's a big, I tell you what, that one is like really scary to me. You're lucky in the UK that the prime minister right now is conservative and he's very upset about this and is doing something about it. Because you know that if the liberals were in charge in the UK, that they would have been like, oh yeah, this is a good thing, and Nigel would basically have to move outside of the UK to live, right? Like it's insane. And they did this in Canada too. All of these protesters, they just because they protested, they're cut off from the financial system. Holy crap, right? and then they want to just exert even more power and control and surveillance over all transactions. No, thank you. Not that a CBDC could be done right. That's the whole thing. Is like you could make it's at least it's theoretically feasible to make a central bank digital currency that has all of the same advantages of cash, except for that it allows that, all of the information is in a public ledger, which allows them to do like more detailed analysis and to get more accurate, granular, and up-to-date information about the state of the economy. And then that would be really beneficial, right? It's possible. It's theoretically possible to do that. But do you think that the government will actually implement it that way? There's no chance in hell that will happen, right? There's no way that they'll do it that way. Which is why I suspect that in the United States, the central bank digital currency thing won't really happen. There will be like maybe there will be CBDC like facilities for you to use, just like we have FedNow, right? And maybe FedNow feels the need, right? But they're not going to get rid of cash. You won't be able to get rid of it. It will be too difficult politically to do it. Yeah, it takes a dumb society to already be transacting near 100% digitally and be convinced. Well, but but here's the thing: is that I feel that the digital facilities that we have available to us right now in the United States are a little antiquated and lacking. Like it's a little ridiculous to me that, if I want to transfer money from my PayPal to my bank account for free, that it takes 3 days, right? So I think that there is a need for some modernization there. Mm-hmm. So they're getting into work this morning and they're noticing something. And they're telling me to look into it. He's just pointing out something that we need to investigate. We'll do after the stream. Good morning, Moroccan. Can you read my question? Oh, yeah. Why don't you trade more volume? That question? I'm sorry. I totally missed that. So right now, my main excuse is that it's summer. I mean, the thing is that is that when I moved smaller, I did better, right? So, no, the over one, the other one. I don't think I see the other one, unless I'm not seeing. Sometimes there's a difference between if we actually get enough stuff going on, there's a difference between live chat and top chat. That CBDCs are being created to control. That's the whole point. Once cash is removed, they can do whatever they want with us because, well, if you don't follow the rules, we just block your bank account. Right, but like, again, that's the thing is like kind of sounds like that if you don't follow their rules, they can already block your bank account. And that it's even worse than that, that it doesn't even have to be the government, that the bank can just decide that they don't like you and block your bank account. Right? Like, it really is. It's so funny. I think it's from the stuff that people talked about and were concerned about when I was a kid compared to what happens now. It is like what actually ended up happening is so just deliciously ironic. Because when I was a kid, the thing that the guys on the left were constantly complaining about was you guys on the right, you let corporations do whatever they want. You give corporations more rights than you do people. And we're going to end up in a world where there's a dictatorship by the corporations rather than the government. You're creating this monster in corporations that can control everything, right? And people were kind of like, oh, well, that's maybe a little bit fantastical because we as conservatives believe very strongly in rights. And if anybody is infringing upon those rights, we're going to push back against them, right? And then what ended up happening is that it was actually the left were the ones that decided to give the government this power and everything to start exerting this kind of control because the liberals felt that their moral positions were so important and it was so important that everybody in the society followed them that the corporation should be allowed to start treating people differently and cutting you off from your bank account based on your political opinions. Right? So it was the thing that the liberals complained about, but then they were the ones that actually created the world that they were fearing. This is just so crazy how they pulled that off and basically captured the left and turned it into the monster that they feared is just so scary. The Microsoft earnings yesterday was like an uncertain CPI number. It really was, wasn't it? Dude, like the S&P 500, we'll come back over here. Like, jeez, man. The S&P yesterday is just such a mess, right? Going in because there's the close, that's like the close, and then that's like the other close, and then there's like a 15-minute break, right? But you can see all of these big candlesticks around when all of the tech earnings came out. It wasn't just Microsoft. I think it was like Google too, wasn't it? Pretty crazy stuff. I still think CBDCs are about shifting how inflation is mitigated. Maybe. That comes back to this whole thing that they were saying that like they wanted to have a central bank digital currency where the Federal Reserve could directly put money into people's pockets, right? I think you're kind of on the right track, but I don't think that they would ever explicitly do that one thing, right? Because the whole problem is managing inflation expectations, right? I think if there's something that we have learned or that we should learn from this crisis, I don't know if everybody's going to learn it because this is kind of like wonk stuff and like quant stuff, and not everybody's paying attention. But one of the most recent research out by Jean-Philippe Bouchot is using an agent-based network to kind of simulate inflation dynamics. And what that study suggests is that managing inflation expectations is the most important part of managing inflation, right? Well, how do you manage inflation expectations if the government is literally putting the money directly into people's bank accounts on a regular basis, right? The point at which you start doing that it would completely undermine the whole financial system, because most people are still under this illusion that money is something that doesn't grow on trees, right? That's the great lie. The great lie is that money doesn't grow on trees. Actually, we can make it out of thin air whenever we want, and there's a great utility in doing that. But the problem is that if everybody, really truly understood that's what we were doing, and they were looking at it on a daily basis, then it completely destroys your ability to manage inflation expectations at that point. Because people just expect that, well, the government will probably just put even more money in my bank account, right? Okay, so we see companies like Vanguard and BlackRock own pretty much almost a bit of everything. I'm pretty sure that these corporations have a word in how things are being dealt around the world. Well, so yes and no. It's kind of a weird thing the way that those work. So yeah, index funds have become like massive. These two index funds in particular over the last 10 years have just become so incredibly big. Okay. Now, the thing that when you see, this is another one of those things that conspiracy theory people love to talk about, and they're kind of right, but then I think they kind of miss the forest for the trees here. So, like, the thing that you got to realize is that in like 2018, 2019, BlackRock started to come in and started to say, like what we're currently doing with corporate governance isn't working and we need to change it. So the way that it used to be is that they just made all of the decisions, and the decision that they always made was whatever was going to be best for the shareholders, right? Okay. Well, there's a big problem in this, in that part of the kind of like the check on corporate power in the United States is that they're public companies. And so the public shareholders can vote and force a company to behave in a certain way if it's against the public interest, right? And so that maintains this balance where a corporation wants to maximize their profits, but they still need to do so in a way that is congruent with the public's best interest, right? But if all of the shares are owned by a large index fund, and the large index fund says, just do whatever makes the most money, now all of a sudden they're not connected to the public interests anymore, right? So that was when BlackRock came in and said, actually, we do need to start exerting some degree of power in corporate governance, right? And so the most prominent way in which this has displayed itself to us is a lot of these corporations going woke and pursuing equity, diversity, and inclusion initiatives at the expense of shareholders, right? Because what ended up happening was, okay, so we are going to start exerting some corporate governance influence. We will do so in line with what our founders' top priorities are, right? Well, okay, now you have a problem because not everybody agrees with that approach to things, right? Because many of us are very concerned about how these kinds of quote unquote inclusion efforts harm meritocracy and make us weaker and less effective, right? So BlackRock and Vanguard and Fidelity and all of these, they have been working, because part of the thing is that I think that the technology and everything has kind of only just now gotten to the... I don't think people realize what it takes to like run large distributed applications. Okay, like So I guess I can tell you guys this now. I changed jobs. So I kind of been hinting at it, but I changed jobs. Before I was working for a healthcare exchange. The company that I work for now makes software for car dealerships. It's like customer relationship management for car dealerships, right? And, these guys, they have things pretty well set up where I can kind of they have really good app monitoring, so I can see like any time that any user sees any kind of an error, I can see it. And then if users are seeing too many of a certain kind of an error, then it goes, oh, we need to go in and look at that and do something, right? But you're talking about hundreds of people working on this application and keeping it going, right? It's not cheap, right? And so going back to the ESG thing, okay. If you want to have a system whereby if you own shares in BlackRock's index fund and you want to vote your portion of the shares, right? Designing a system that can actually facilitate that is not trivial, let's say, right? So the technology is only just now kind of gotten to the point where everything's in the cloud and everything, and they can do it at a relatively cheap cost. Because the whole thing is that you're going in and you're creating a system that's quite expensive to maintain for something that most people aren't going to use. Like, that's the whole thing, is like, okay, so we have a problem here. So what's the solution? Let people vote their own shares. But the index fund doesn't say anything, and individuals vote their own shares. Well, the problem with that is that none of you are going to do it. Even us here on this stream, let's be honest with ourselves, guys, because even us that are like really engaged in this sort of stuff, the number of companies that you're actually going to vote your shares for is probably very few, right? If at all. It's just like too big of a hassle. It's one thing if you own like 5 companies, right? And so you have a very large portion of your income invested in this company. And there's only 5 of them, and so you're doing all of the research about how you want to vote in that particular initiative, right? That's a very different thing from like, I own a little bit of every company. When there's a big issue that comes up, I vote my shares. Like, it just doesn't work, right? So I'm with you, Brad. Number one reason why I don't like 401ks, I agree. I think that, in all honesty, because it's a really hard argument to make. It just pains me so much. Like, because I know when I'm saying it that like it's never going to happen. Because 401ks are so beneficial to investors, right? The ability for a regular person to just own a little bit of every company and be perfectly diversified is just that you just can't put a value on how valuable that is to people, right? And it really is like the best deal in terms of public investing that I think you're going to get, right? But I honestly think that society would be better off without it because of what it's done to corporate governance. I think that index funds should just be banned. Like everybody can invest in whatever they want, and you don't pay capital gains tax unless you make over $200,000 a year. And then you have to invest directly into companies. Right? And so everybody will have to pick companies that they believe in and invest in and things like that. And it'd be a very different world. But it would be a world where corporate America is more accountable to the people. It would be. And it would be a world where I think valuations would matter a lot more. I think that there would be a lot more checks on the market because, like, right now, I feel like that with the index funds and everything, that it's just like everything goes up all the time. And, I guess the index funds, from one perspective, the index funds provide a lot of opportunity for us, right? Because we can tell very clearly then in certain situations where the market is really just, especially when we're on the downside and we've come down too much, right? Where you can make good investments. But is there an alternative to a retirement system based on index funds and Social Security? Well, of course there's alternatives. I don't know how would they be better and worse is a really complicated question, right? But the more generally speaking, my opinion is that the more people you have investing in individual stocks, the better. Is the way that I would put it. So then on the split side, I have a different proposal. Okay. So here's my new proposal. I think that you should be rewarded for owning individual stocks. So that could be, if it's an individual stock, you get a little discount or something. You know what I mean? So I guess the issue is again, like, why would you put the money that you put into your 401k? Why would you put it into individual stocks? You wouldn't. It's kind of not very smart, right? But the reason it's not very smart is because what you put into your 401k is tax free. So, okay, so if you got rid of that thing, so step one is you can no capital gains tax for people making under $200,000 a year. Okay, so now you can invest into anything, right? How much of it do you put into individual stocks versus indexes and stuff? Well, I would probably still keep it as like, you want to put 4% of your income in, and your company should match a certain amount, and you should put that into the index, right? So then if you're going to put like 10% of your income into saving, you know, then I think that you could put another 4% into individual stocks, maybe. Assuming that you could afford to then spend that much. That would be the next step, is to put 4% into stocks. But then there'd have to be an incentive for you to put them into stocks. So that's where I would say that, like, the taxes for an index fund or an ETF, if it's not within your 401k, should be more than for individual stocks. Or maybe for individual stocks, you get a little discount. You know, you could do it the opposite way too. But I would like to see laws that incentivize individuals owning stocks. But there's kind of this whole other thing about it, which is just that the market has become digitalized, right? Because one could point to the omnibus bill back in 1992, when 401ks were created and so forth, as the origin of some of these problems. But I also think that the digitalization of markets and so forth also kind of plays a role, and that a lot of this stuff would have happened even without the 401k framework, you know? So that's why I think that from a market microstructure perspective, that we have to start thinking about giving people incentives to do the things that we think will help the market. In Switzerland, if you're not qualified as a professional investor, you don't pay any capital gains tax. That's awesome. So then they don't have like tax advantaged accounts there then, right? I heard some weird rules about taxes in Switzerland though, and some things that were like, we were told that were just outright false. I forget what it was, but the system over there is so different. I kind of always thought that, oh, the rules that they have for these things in European countries, you know, are pretty close. And they're just kind of like a little friction. No, like in some of the countries, like the whole regulatory framework is just completely different. Okay, so can you clarify what order flows look like? Well, so when we talk about order flows, what is an order flow? An order flow is just orders, you know, a group of orders that we expect to come in trading on a certain thing, right? Those are the flows that we expect to see. Okay. Now, the question is really, I think what you're asking is, how do you see the liquidity hole? Right. And on that part, that's where, like, I really don't think you can see it on the footprint. That's where I think that there's kind of a major flaw with a lot of these analysis forms. You want to watch it live as it's happening. So how do you see it live as it's happening? Well, I think that there's two parts. The first part is understanding what causes it in the first place, right? What causes it in the first place is too much liquidity being taken out too quickly, right? When you trade against the market and you take liquidity from the market by entering a market order, right? It takes a certain amount of time for that liquidity to be replaced by a new liquidity provider. So if too many of those liquidity providers get taken out too quick, quicker than they can rejuvenate, then you get the liquidity hole, right? So that means number one would be a very large transaction. So like really big icebergs have a tendency to create these, right? Another thing would be a quick sweep through a price. So a quick sweep kind of also causes this because all of the liquidity providers go, whoa, what's going on? Maybe I don't want to take orders here because I don't know what's happening, right? So a quick sweep can do it. And then the third thing that can do it is just price kind of settling there for too long, right? So the thing that you want to see then, so those are the things that cause it. So what you want to do is you want to see, okay, so I saw one of those potential causes. I saw an iceberg. I saw a quick sweep, or I've seen it that it's just kind of been sitting here for a little bit, right? And then the next thing that you want to see are the signs of distress in the latent liquidity, because you can't just see it in the resting liquidity, right? You need to see it over time in the latent liquidity. So what does that mean? That means that like when you see a price taken out, very little is bid or offered behind it. So we tick up or down. If we tick down and it trades 200 contracts and then there's only 200 contracts offered, and then they trade it back up and then only 200 contracts are bid, and it goes back and forth doing that for like 40 minutes, that's a liquidity hole. That's what a liquidity hole looks like, right? You have to see it as we go through each trade, right? And you'll probably see it across a few prices, right? Versus a market where, they're taking out large amounts, which is kind of more trending behavior. So what you will see on the footprint and the volume profile eventually is a lot of volume trading in that location, purely because it's sat there for so long. So like an example is like if I put a footprint chart up and I have like a 5-minute footprint chart, right? And I will see not a whole lot being, nothing too unusual looking on the footprint. But then when I come and look at the volume profile, it's like, oh, but a lot did trade there, right? That's kind of what you're going to see in those. But the thing that you really need to watch in order to see it as it's happening, in order for it to be useful to you, is watching it on the DOM and watching how much trades every time that it ticks up or down. And if you're persistently seeing not a whole lot being traded as it moves, and it's kind of stays in a narrow range as it's doing that, that's a liquidity hole. But you cannot see it like on a footprint, because a footprint is like aggregating that over 5 minutes, right? You have to see something about like every time that it trades up or down to be able to see. So another sign of this would be like you see a lot of orders put on here. Like right now there's 18, 15 at 27, right? But if they decide to hit it, like if orders started to hit 27 and all of those orders cancel and we tick up on like 200 contracts, right? And then it doesn't really go anywhere and it comes back down, right? Like that again, it's a liquidity hole. Like the people that are putting up the liquidity pull it really quickly. They're really they seem hesitant to want to take on a lot of contracts in that area, probably because they already have too much in that area. Well, it sounds like a spoof. I guess it's similar to a spoof. I wouldn't explicitly call it a spoof because it's there for a different reason, right? You put the contracts on there to get a good spot in line, and you're not necessarily expecting to get filled. You just have it there just in case. But then if all of a sudden something happens and it seems like you're really likely to be executed, the algorithm pulls the contracts. Yeah. And you'll see that happen in those locations. That's where the people that got spoofed argued, well, why don't the algorithms get slammed for that? Well, because the algorithm isn't trying to manipulate the market into filling them for something like that, right? They're just trying to reserve a spot in line, which maybe shouldn't be allowed either, but whatever. In all seriousness, if the robots weren't around, we would probably be doing that. We would probably be, every time that it ticked up or down, putting a few contracts on there and then canceling them if, we were concerned that we were going to get executed and we didn't want it. That part of the video was super complex. It's going to seem really complex because this is a new concept, right? But that's why I, at the very end, I kind of said, okay, so what do you do with this information? Well, the first thing is you got to avoid a liquidity hole. Okay, which means if we're in a trend and then you start seeing a lot of money trading into one spot, you should be really careful, because that's the sort of thing that creates a liquidity hole and causes it to go sideways for a while, right? And so in that situation, it might totally make sense for you to still go long on it continuing, right? But if you don't want to sit through that for 45 minutes, so you should wait and only do it at the time at which it's ready to go again. That's the biggest takeaway, right? Where did you get that? Well, I'm just taking the research and trying to apply it to you as a retail trader, right? See, if I was talking to professional traders, what I would say is, okay, so what you want to do is you want to move the asset a little bit and then create the liquidity hole and then try and get as many contracts filled in the liquidity hole as possible. But you've got to do it as a slow trickle, right? And then after 45 minutes and the liquidity has healed and you can kind of see it that the market is free again, then you take out that new liquidity that is formed and you do another move, and that's the next leg, right? And that's what I'd be telling them, and saying, yes, you are moving the market and everything, but actually that will get you a better price than if you just executed it anyways, right? Because either one's going to move the market. But since we're trying to follow those guys, instead we would say, well, you don't want to get involved in the liquidity hole, you want to avoid it. So kind of interesting, we had a pretty decent trend up to begin with here, and it has since come back down. And the cumulative delta, particularly in the 10-year, if I can come back over to the charts there to kind of show you this analysis, the cumulative delta in the 10-year treasury has been pretty persistently to the downside here. So it was just this one temporary bit, and we've already canceled that out in volume. So it looks like there is some sort of a meta order short going on here, possibly. And who knows, maybe they break to new lows and there could be a bunch of people trapped and then things could get a little bit exciting. I have to say, this is a lot more action than I anticipated for today. It is to the short side, so I suppose we could try participating here with it. The concept is homegrown. I think so, to some extent it is homegrown, right? I'm taking research and I'm applying it to retail traders, because that's the thing, is that nobody in the retail space has ever really considered these things from what I've seen. Then what new order management are you talking about? I haven't looked in a while to see if there's been a new Jigsaw version. They've kind of been stuck. Might be a little late for the trade. There is a new release. Let me look here then. Is it 4019? Added break-even stops and trail before stops. Change the frequency of search for new accounts to comply with rhythmic changes. Added reversal footprint charts. Do you think the big traders on ZN work the charts based on where their costs? No, I don't. I think that my understanding from it is that they hardly look at charts at all. So am I supposed to be selling what? No, I don't sell snake oil. If there's anything that I quote unquote sell, it's execution software that works and does a good job. Right. But I think Lucas is talking about what I've told everybody in the volume profile video, right? I think he's saying aren't there some people that might be a little bit upset if more people in the retail space understand this concept? Well, not really. Because the thing is if we're all trading now in accordance with our best understanding of the market to optimize our trading based on the stylized behavior of markets, theoretically it shouldn't really change anything, right? Because those behaviors exist because of the market. And so really all I'm doing is protecting you from yourselves by giving you a little bit more information, but it doesn't necessarily give you an edge, right? It could mean, I suppose, it could mean that the informed traders might have to work a little bit harder for their liquidity, but there's still enough randomness in the market that they'd be just fine. Oh, I see what you're saying. You're saying you didn't know that there's a new Jigsaw version. You were supposed to be selling this. They don't like send me an email when they put a new release out or anything like that. Break even stops and trails before stops. So that just means that you can add it into this thing, right? Positions. Yeah, they do send. Let me rephrase that. They don't put out. I don't get some sort of special information that you guys don't get. That's what I meant. Let me see here. And then the email that I do get, it probably is buried, behind. Oh, July 25th. Oh, so it was yesterday. I'll update that later. This is the video. Do they have a video showing you how to use it? No, this is something else. Oh, this is, I've seen this before, yeah. This is the one about George Soros, right? Oh, no. This is... This is that one. This is that 2 News one that's just like about a bunch of different people. Yeah, I've seen it. That list is a pretty good list there, it looks like. Do you usually avoid the opens in treasuries? So when it comes to like the pit open, man, I tell you what, like some of your best opportunities are going to be like right at the open, but you know, the issue that you get is like the more that's going on, the more there is to screw you up, right? So there's kind of this level of activity that's like really good, and then once you start to get to that higher than that level of activity dies down. Like if I were to draw a graph and the x-axis was the amount of activity and the y-axis was good for me, you know, then, you know, low activity is not very good for me, and it kind of comes up to this, and there's like this peak area, and then it kind of draws down like this, right? So I think that the open kind of lies somewhere in here, and the FOMC is like right here, right? So if I have an edge, if I have a clear reason to believe that hedgers are going to be out aggressively buying or selling in one direction based on a piece of informational news that I have, then yeah, the beginning of the pit session can be a great place for me to go and take it. You just take it as she goes. You should get a good little trend, and you can just kind of sit in that. But that said, most of my trading happens, you know, sometime after economic news, when there is a clear, what's the word? You know, I should turn on focus assist right here for now. Anyways, sometime after the news, when things have kind of calmed down, is when most of my trading takes place. That's why you need to potentially have more instruments to look at. That's a different thing. So I saw this post on Reddit that was like the best post I had seen in a long time in the futures trading subreddit, where this guy, he knew the wheat market. He saw the news about Russia attacking the port and took the long, and the wheat market hadn't really reacted yet because they're kind of slow on news like that. He took it, he held it for like 2 days and made $30,000. But that was because he knew how that market worked and stuff, right? There's a real advantage in knowing about that market. And I kind of feel that it's unrealistic for you to know enough about the treasury market and enough about the equity market and enough about the gold market to trade all of those back and forth every day. You're doing a different type of trading when you're doing that, and it's a type of trading that I don't know if you could pull off very well in the current environment. During quantitative easing, when QE was in full force, then you could totally do it, but there's like real serious trade-offs to trying to trade all of the markets. I don't think it's very appropriate for very many people. Yeah, I would just only watch the treasury market and learn that one really well. Yeah, I think so, especially when you're just starting out, right? But yeah, like what I want to see. What I want to see is, you know, a market that is relatively quiet but free, which is to say, like, there's not a liquidity hole. The liquidity is healed and is relatively healthy above and below us, but there's not actually a ton happening there at that time. And that is kind of the quiet point where you can get in before the meta order comes, and then when those people come in and they start the trend, and if you're correct, then you just write it until you see the liquidity hole form, and then I usually get out at the liquidity hole. Well, options is a totally different game. But like that's the whole thing. Is so like if you're trading options, I really would not recommend trading options as like a market maker perspective in options without some software assistance to tell you what is a good price. You just wouldn't do it. You could trade it from the, you know, buying the buys and calls based on, you know, something that the market hasn't figured out yet. But otherwise, I got a few years trading with technical analysis on EA, but that didn't work as expected. Well, yeah, but it's because that's the thing. This is the thing that I think is so funny is that ES ends up being kind of an exception to the rule for almost everything. Okay, so like the stylized behaviors of order flow that we're talking about, they happen in every market. They happen in every market for sure, but they're a lot more powerful in a market that is a pure commodity and has a lot of liquidity, which really makes the treasuries like the best place to watch and see these behaviors. That's why it's so good to start out on the treasuries, because you can see what's happening so clearly. And yeah, if I can comment on what I'm seeing, it's just there doesn't seem to be like a whole lot happening here at the moment. It kind of looks like there is maybe a very small, slow and steady meta order selling here, but it's not getting too aggressive, and there's no way for me to know if it's going to continue or not. Right. ES, on the other hand, it's an index with a bunch of different individual stocks. So, and all of those individual stocks will exhibit those behaviors, and as a group, they can kind of all run into, you know, a liquidity hole at the same time, for instance. Like that totally happens, but there's a certain amount of randomness that's over there. There's a certain amount of randomness, and that makes it really hard to trade successfully. You know, with the way that I trade, if I get in a trade, it should work. You know, like it was like yesterday. You know, I got in, I wasn't seeing the cumulative delta really move the way that I want. The book was not looking the way that I want. I got out because I'm not seeing the meta order, right? And just get out. And ES never works out that way, right? Because the ES just moves around anyways. So it's really, I don't think people realize how hard. When I was speaking to the traders when I had the bank job, okay, one of the large U.S. banks. And you know, they're like, what are you most interested in? And I said, you know, E-minis, and they laughed, you know, and none of them traded it, right? They said that it's crack for traders, but it's really hard to get an edge in it because so much of it is just random. So it's just really kind of funny that ES is by far the most popular instrument for retail traders because it's probably the most difficult one to trade. The NASDAQ in particular, that's freaking the Widowmaker. Y'all crazy that you'll have trading that. Yeah, I'll be here for FOMC. It's going to be a little weird today because I had a doctor's appointment and I thought it was yesterday. I had it in my phone for yesterday. And I guess I put it in my phone wrong and it's today. So I'll only be able to stay for the FOMC meeting, and I won't be able to stick around until the close like I do sometimes. It's juicy. Well, it's tempting, right? Everybody wants to trade it. The difficulty with the ES is that every once in a while, I do have a situation where I really do seem like I have a good edge on knowing where it's going to go, right? And you can make so much money from trading those. I guess what I'm saying is that if I did start to trade ES again, I would be much more selective. It would be like once a month I would come in with like, oh, I have a strong enough edge that I think I'll take a trade in ES or something like that, right? I think my best shot I'm making is focus on these markets journaling every day, and eventually I get there. Yeah. Well, because the thing that. So what I'm trying to do with this channel, one, is share with you guys a lot of this quantitative information that retail traders have missed. But then the other side of that is that all of this data kind of suggests that there's more opportunity for you as a retail trader from informational inefficiency than there is from like technical analysis, right? So yeah, that's why it's so good to really laser in on a specific market, because there's just so much to know about each one of these markets and events that are specific to them and things about how you value them and so forth that are specific to them. You know, and those are all things that can potentially give you an advantage in certain situations. Right. Would you consider this a liquidity hole? You sent a picture. I mean, no. I don't think so. So again, I don't think that you can necessarily really conclusively see it in on a footprint chart. But see, what you're doing is you're saying there was less volume traded there. But like that's the thing, is that the latent liquidity will be low, but the amount of volume that ends up trading there ends up being high. So the most likely case is that the point of control was a liquidity hole. That's usually the end result, is you get a liquidity hole and that liquidity hole becomes the point of control. So if you're doing this right, you're watching the DOM, you should be able to watch it and see the things that kind of lead to the liquidity hole happening, and then be able to say, okay, it looks like they're going to start building a hole right there. And then after a few minutes, you'll look back at it and you'll say, yep, see, now it's point of control. Right? But see, the whole thing is that by the time it becomes the point of control, it's like probably too late for you. You've probably already tried taking like 4 or 5 different trades and like really frustrated. Which way is it going to go, et cetera, et cetera, et cetera. Whereas if you understand the liquidity hole thing, it's like you're already going to have been in a trade because you knew which way it was going to come. And then you see that they made the hole. You're not expecting any more volume after, you're not expecting a second leg. You just get out and then you avoid all that drama. Right, and then you get to sit and chat with YouTube chat instead of stressing out about which way it's gonna break out of your little range. Okay, so I felt like I covered that, but I'm going to do it again because maybe I can do it a little bit more concisely this time, okay? So there's 2 things that you want to look for, right? Number 1 is you want to look for the kind of events that are likely to lead to a liquidity hole, followed by the signs of low latent liquidity, okay? So there are 3 major things that you can identify that are likely to lead to a liquidity hole. One would be a large transaction of some sort. So if you have like a 10K iceberg order that appears out of nowhere, that's really likely to form a liquidity hole. It's almost always the case. I think you will find whether or not they go through that order or they reverse, it will almost always be the case that they will kind of come back and revisit that price first before doing anything crazy, because it's like a magnet. Okay. The second thing would be a slip through prices really quickly. So like, if all of a sudden we move from 27.5 to 30, just like that can also create a liquidity hole. Okay. And you got to be careful about those, because that could also mean news and something that's going to create a continuation. But when that happens, the market makers are like, whoa, hold up. And they don't want to put liquidity out, right? So that can create a liquidity hole. And then the third thing would just be, if you hang out in a certain location too long, it's like everybody that wants to get filled in that location has already been filled. And then there's not as many market makers available in that spot anymore, right? Because again, what causes the liquidity hole is a lack of latent liquidity. Okay. So then what are the signs once one of those things have happened? What are the signs that you're going to see that there's a liquidity hole? Well, the thing that you're going to see, because you can't just see it on the resting liquidity, because a lot of liquidity providers don't show their liquidity until right before they're executed, right? But what you're going to see is it's going to go back and forth at a price with not very many contracts bid or offer. So we trade up and it's only 200 contracts to trade up, and then we trade down, it's only 200 contracts, and we keep going back and forth like that. Probably a liquidity hole. If in the rare event in the treasuries where they hit the bid, but then like nothing bids and the price is just like blank for a few seconds, this doesn't happen very often, but it happened yesterday, right? Sign of a liquidity hole, right? Or the other thing would be, because it does kind of happen across the range sometimes. It's not always just at one. In treasuries, it often happens at just one price. So it's like really obvious it's happening, right? But in most instruments, it will kind of happen across the range, right? And what you're going to see is like, if they do start trading up, most of those contracts just pull, right? It'd be like all the contracts pull until you get to a certain point where there's like like at 30.5 right now, right? It'd be like probably pretty easy for them to move up to 30 possibly. But then if they wanted to get past 30, they're probably going to have to start trading thousands of contracts, right? So that's kind of like the edge of the hole. Okay. So that's the two kind of behaviors that you will see, right? Now, those behaviors that you will see, you're only going to see that if you're watching the DOM, because it has to do with how much it takes every time that we tick up or down, essentially, right? So you kind of have to see how much volume traded every time that you cross a price, which Jigsaw's current trades column allows you to see really, really effectively. Well, so a big order in and of itself is not necessarily a magnet. So if you were to say like there's a really big limit order placed on the DOM, a lot of people think that that's a magnet. That's not true. Okay. But a lot of volume transacting in a single spot, and I don't think it's like a magnet. I think a magnet is kind of the wrong kind of wording, right? I think it's more like a hole. It's like gravity. It's like you're kind of in this hole, and in order for you to get out of the hole, you're going to have to expend more energy, right? So that's where, that's kind of why when you're looking at like pure price, for instance, you wouldn't be able to see these behaviors essentially, right? Because just because we've formed a liquidity hole doesn't mean that price can't escape it, right? Especially if there's a really good reason for them to escape it. Yeah. So, if you were to do a study to say every time that there was a liquidity hole, which way does it eventually go? Or like how likely is it for that to be visited again? You're probably going to get noise, right? But what you will see, what I am kind of saying is, if there is a large iceberg, you're more likely to go sideways in that area in the 10-year treasury, right? . Do you find value in knowing if the market is above yesterday's value area or below? So yes and no. So I've not been able to, kind of like with my volume profile video that we put out yesterday. That's kind of why we're talking about all this stuff. I haven't found some sort of setup where when we're above yesterday's value area high, we see certain behavior and it has a setup for me, right? The thing that does happen though is that there are some stylized behaviors in volatility, right? And in particular, like volatility has like these really crazy fat tails where it's like, okay, so if we have high volatility, then you're likely to get more high volatility. It tends to cluster, right? And you can go from periods of like really low volatility, and then all of a sudden it breaks out into really high volatility, and then it kind of slowly comes back down, right? And so you kind of see that behavior exhibited and expressed in some of these statistics around volume profile stuff, right? So like if we moved outside of yesterday's value area, quote unquote, that probably means that there was something happened overnight that was enough of a change to move the market, right? And ergo, there is a good chance that those flows will continue through that day. And so it's like there's a certain time where it will come and revert back, and then there's these other times, which is like more the fat tails, where it just keeps going, right? And you make so much on those fat tails that it's worth more than these times that it reverts. And that's where it kind of leads into this really bizarre asymmetrical risk reward sort of setups that it seems like you should be able to make money from it, but in reality you don't, because you lose so much when you get it wrong. This is a make up for when you get it right, unless you're getting it right because you know why they're moving and you know that they're going to continue, right? Good luck with that. Well, I think one of the things that I think is funny is that like a lot of the things that the market makers do are really based around waiting for a liquidity hole to form and then trying to play the liquidity hole, right? Because the thing that's really weird about it is like if we say that the liquidity hole is here at 28, which it's probably not. It doesn't look. The action here looks a little disorganized in the treasuries today, okay? But if there was a liquidity hole at 28, then what I'm going to see is not very much bid or offered at 28. But that also means that, if I want to get in line, I'm only going to have 200 orders in front of me, and the chances of me getting filled are very, very high. They've been filled there a bunch of times, many, many times before, right? So I know I can get filled over there. So if I can just happen to get filled short at 28 or filled long at 27, right? And then I can get out and I can take a tick off of that really easily. Now it's really hard to do that in the treasuries because you might see a few hundred contracts go into there, but it's not going to trade 1,000 unless it's like really ready to trade through you, right? But if you can get in a good spot and it's like at the beginning of the liquidity hole, then those are good trades. And that's what I'm doing when I'm taking the multiple contracts, right? Is I'm saying, okay, I have reason to think that it's going to go a certain way, and I think it's going to happen somewhat close. I can use the rotation that we're getting in here to try and, build up a little bit of a profit so that I can have a bigger stop, right? Oh, good luck using past data like previous days point of control as patterns to make trade. Yeah. So this comes back to this analogy that we came up with, a week or so ago that I think is really, really helps you understand, like the approach to trading that we're talking about here is if we were all wildlife researchers and we put a tracker on a deer. And so we're looking at a map and we're watching where this deer is going, and we're trying to find patterns in how the deer moves, right? Well, the fact that in the last 30 minutes the deer has moved north does not necessarily mean that it's going to continue moving north, right? Because you have no idea why it's doing that, right? And most of the time, what the deer is doing is just kind of moving around randomly, right? But if there's a pack of wolves chasing the deer, then I can predict where the deer is going to go very easily, right? Because they're going to run away from the wolves, right? So like the past data doesn't really tell you anything. That doesn't mean that there isn't data out there that does tell you something, right? It's something external to what the deer has done in the past. It doesn't matter if the deer has been moving north for the last 30 minutes or if the deer likes to move north or go into this certain spot, favorite meadow or something like that, if there are wolves chasing it, right? And that's why almost all of these statistics that you get out from the market end up just being random. Because what happened in the past market does not really have any influence on what happens next. Because what's really moving it is the people placing the trades. And what is going to cause the next market move is going to be the next set of trades. And those next set of trades have very little to do with what had just happened. In fact, if anything, they kind of will tend to contradict what just happened, right? So really what you want to know is something that's going to actively cause people to trade in a certain direction. It has nothing to do with the way that it was trading. But if I know that there's a Federal Reserve meeting this week and they're hedging themselves on concerns that you might get some signs from them that there's more rate hikes in the works, right? Well, now you have a really good reason to go long or short, right? This is why you need a deer zebra. Confuse the wolf. You can use zebras and lions. Or sheep. Why are the sheep going where they are? Well, because the dog is hurting them that way. Nah, it's so when you first hear these things, you're probably going to feel one, confused, and two, like you didn't absorb it all. So almost always it's going to be like this is because what's happening is your brain has been completely set up to look for patterns to say, well, there was a head and shoulders, so now we're going to go down. Or here was the price action setup. And so everything is, your neurons are all trying to mirror these patterns that you see in the prices. Rather than trying to say, okay, when this piece of news happens and this piece of news, it causes people to buy. And this is how much people that it buys. Right? It's a completely different framework. And so when your brain sees that, it doesn't have the neuron. You're going to have to understand this. You have to build new neurons, right? So like the reality is you could probably turn around and tell somebody exactly what I just said, but your brain still doesn't understand it because it hasn't grown the neurons yet, right? So, but as you come in every day and you start approaching the market from that direction, not only will you understand it, but it just becomes second nature to the point where, you know, you will switch from wanting to get involved in the market or not wanting to get involved in the market just on pure instinct because the brain sees it without even having to really think about it. Because the neurons, that's the advantage of the neural network, is the neurons just see it. What are your predictions? You know, I haven't said anything about that yet today. So, I do think that there is a risk that the Federal Reserve says something that suggests future hikes. But I think that once again, that Powell will really do his best to try and say nothing. So probably what's going to happen is he's going to say, there are still some upside inflation risks, and we are willing to deal with them as they happen. That's probably the sort of thing that I think he will say. Okay, so it doesn't make a very good bet, does it? Right? Because I think the bet that you could place is go short treasuries, right? Go short treasuries on the theory that he says something that roils the markets and causes interest rates to go up, right? But I think that the better trade here is to have been short treasuries from Monday on expecting people to hedge for that particular possibility and then getting out before the Federal Reserve meeting happens, right? Problem is trading on gut feeling when the right, or the guts have been trained on noise, which is what most traders are doing, right? Even a lot of order flow traders, I think that they're training their brain on noise, because there are definitely patterns and things that happen, but it's just like you'll see a thing happen and then like the outcome after that is kind of random, right? And unless you know what the larger thing that's going on. If you know the larger thing that's going on, then you can interpret it really easily. And sometimes you're wrong, and you should be able to realize that you're wrong very quickly because, it won't be doing what it's supposed to. Oh, I don't think that this is a top. Everything that I've said to you before, D. Multiple times. I want to hear more about the deer. Well, I kind of thought at the beginning of the day here today that there was some wolves out here chasing it, but it's kind of like come back down and started to do some random stuff, and so I'm thinking that the deer just felt like taking a little bit of a run this morning. Sometimes you speak like a computer, and today you speak like a human? I don't know. I feel like, so you know what I think happens to me is the way that I talk and the approach that I take to talking will change randomly, and I'm not aware enough of what's going on to understand what package from Jigsaw do I need to trade futures? So if you're purchasing the Jigsaw software, there's a bunch of different options, and the only difference between those options is the education that is provided with it. And it is good education, but the vast majority of people just get the most basic one, right? That one does come with some education, and it's just the basics of like, what are you looking at? So, the videos that I have kind of teach you similar things, although what they have on Jigsaw is a lot more like broken down and slower. So it would be really good for somebody that's new. But that's the only difference. So, like the professional package, right? Like I would not recommend that you buy the professional package unless you just have the cash to burn. Right? You need one of them best mics that you mean like the SM7B? I think I've gotten to the point with the microphones where like, which microphone you get is mostly a matter of preference, but I could use a better audio interface. A better audio interface would probably make a bigger difference. And that difference would probably be one that you guys wouldn't even be able to tell anyways. Expands the voice. Well, if I went to a dynamic mic, that would expand the voice, right? But then you would pick up more background noise, like me typing. Do you use footprints? Not very often. So I'm only gonna look at footprints if like there was a move that happened overnight or when I was not there that, you know, I missed and it's not completely clear what happened. Then I can kind of try and look at the flow retrospectively to try and sort out what was going on there. Is a bit confusing. I'm debating between Sierra and Jigsaw, but you'll get to them. Well, thank you very much. I really like the Jigsaw software. I mean, I've tried Sierra charts too, but I just couldn't get myself to love Sierra charts, you know? It's just, you know, it's a really good full-featured package and it's a little bit cheaper, but I think ultimately Jigsaw is better software. I'll have to look at after the stream. It's already 8:30. This last hour went by really quickly. So we might be getting this hole here at 27. There has been a decent amount of volume trading here, and it's been kind of flat for a while. But we've kind of been free moving for a while too, so that might just be a lack of interest. See, I'm not like right now the bid and offer are equal. It's 1,000 by 1,000, right? So that does not tell me that there's a liquidity hole there. If we traded back up across 27 and it hardly took any contracts to do it, then that would tell me that like we are. But I think this one might be a little bit different price wise. Well, so the problem with Jigsaw is that there's an upfront, right? You have to pay like, what is it, $500 to begin with, and then to trade live, there's the $50 a month thing, right? But for most beginner traders, what happens is you pay the $500 up front, and then you trade on Sim, and you don't have to pay for the license to trade Sim. So you trade Sim for a couple of years, and then by the time you've saved up and you're ready, it doesn't, you know, that monthly fee is no big deal to you. Whereas with Sierra charts, you know, there's no upfront cost, but you pay that something that's a little bit less than the Jigsaw monthly license fee. You're just paying that from the beginning. So like there's the difference. Have you tried? I'm pretty sure that I have, but I definitely don't have it installed on my machine right now. Oh wait, isn't the Edge Pro X based on Motive Wave? I forget which one that's based on. I think it's Motive Wave. But kind of the thing when you get into a lot of these other platforms is that like they focus on chart tools, you know, which I understand why. Like honestly, if you're gonna make a trading platform and your goal is to get the most number of people to buy into your trading platform, it would behoove you to focus on charts. You know, I would basically like copy NinjaTrader, right? But most of these little things that these other platforms have that are like different from NinjaTrader are just that I don't find valuable at all. I'm surprised you haven't programmed something. Well, yeah, because this the thing is I can't really find a way to quantitatively identify them that they've happened unless it's like already over, right? So like I do have some indicators that will show you things that are likely to cause liquidity holes, right? Like that's what Gabby is about, or sorry, what is it called? Pulled prices. So in the Speculator Seth Elite Indicator Suite, the pulled prices, it will draw that square and you'll see, just watch it, man. Like their tendency for them to come back to that little square is very strong. Unfortunately, it doesn't really like explicitly help you. But I mean, I guess one of the things that you can kind of do is like a liquidity hole is again like the inverse sine law, right? Is if we're moving down, like if we had a liquidity hole and then we're moving down, right? And they start to get stuck and they kind of start to form another liquidity hole. And then all of a sudden you start getting another meta order coming in the other way. You take that and it will probably go beyond that first, because what will happen is that first liquidity hole is maybe still there and you just slide right back into it and then come out the other side with more momentum. Yeah, it doesn't work as well. Look, because the thing is that it's intended to really show when it's just like slipping, you know? And so in equities, you can come in and you can say like, what if just nothing actually traded at that price, right? That happens all the time in equities. In treasuries, that will never happen. There will always be a certain amount of trade, right? So you could say, if we traded across, let me try and do an example. We can try and pull it up and try and make one. I think last time we were talking about this, I felt like it didn't have enough free energy to like do something with it. But like, if I just put this on a 1 minute chart, I'll put tick replay on. Indicators. Hold prices. Minimum gap size 1, and I will add allowed volume to be like 500. It should draw some. Let's see if it does. Oh, maybe not. I might need to look at it because, oh, it's not. Signal, no. It definitely works really well on ES though. Huh. Is it per price? Hold on. No, now I feel like I need to look at the code. See why it's not showing me any in that instance. You got it to draw some with if you set it to 500 in ZN on a 1 minute? Did I not set my data correctly? Tick replay. Did you have tick replay on? How long have you been trading? So I've been actively trading futures since 2017. So you can do the math. I've been watching the markets much longer than that, but this is when I actually got into like active day trading, I guess you could say. Before that, I was kind of more swing trading. Yeah, I think there's something wrong with I think there's something else going on here besides the indicator, because Doozy's got it to work with by setting it to 500. Because I see here it says, okay, if the offer changed, the ask is is bigger than the last ask, plus the tick size, which is, you know, so moved up more than our gap. So I think the gap is 1, and then buy volume is less than size. So if I set it to 500, that means that it moved up on like only 200 or 300 contracts. It should be showing something, but it's not. Especially with me setting it to 1500, it should definitely be showing something. But maybe my tick replay is not working, and maybe it's not working with tick replay correctly. No, that doesn't make sense either. If I come in here and I just add, if I add Sim22's cumulative delta. Okay. I don't know. Really weird. Well, that doesn't... What you're showing me doesn't look right either. Oh, no, wait. That's somebody else is showing me something else. What is that? Oh, no, wait. That is you. You changed your name. Oh, okay. I'm like, wait, that's not easy. But that's not what it looks like. Oh, no, it is. It is. Okay. Yeah. It does. It shows the ones. Yeah. And they're in correct locations too. Okay, but you have it on a 5 minute. Let's try it like that. Let's try it like a 5-minute chart. And like go back a few days. Like I think you have like 10 days on there, right? Because it's definitely not something that's happened like today. One. Change the gap size to 1. There we go. Okay, so now you can kind of see it. So these would be slips, right? These would be slips, and what happens? Yeah. So it's like gravity. It's like they want to get away from it, right? Like they're still selling, like right here, like they're still selling, right? But because the liquidity above them is gone, it's like they just keep slipping back up and into it until the liquidity is kind of healed enough that then it continues going through, right? So like another example of this is like this thing right here. Okay, so why is there like support like that so strong? Okay, because a typical chartist will say, okay, so this is an area of support, right? I should be able to buy it here, and you know, as soon as they buy it, goodish, they get destroyed. Well, why is that? Because it's not actually support. It's a liquidity hole, right? Like look at this is like volume is just going sideways, right? They basically they had scared the market so much that they have to completely pull back on doing anything until it kind of starts to come back up like this. Now there's liquidity for them to sell into again, and they can do it again. Right? And this is where the charting I think is so frustrating to me, the way that most traders approach it, because what the traders want to do is they want to say, okay, here is a gap. I will buy it on the theory that it's going to come back to that spot, right? Like you're looking for like some entry that tells you where to get in and where to exit and what your stop is and all of those sorts of things, right? But the past just doesn't predict the future very well. But if I know what's going on, if I know that there's a sell order, if I know that there's a large meta order sell, I know it's going to do this. I just know it. It's always going to do that because like because of how liquidity works, right? And so I might not be able to predict the future with the chart, but what I should be able to do is I should be able to completely explain why it's doing that. And I don't feel that most of the analysis out there really has reasonable explanations for these things. They'll say, well, because it bounced here, that must be support. But it's like, yeah, but the volume doesn't support that. You don't see people down here absorbing contracts and buying it or anything. I guess you can't see that from cumulative delta, but there's no evidence in there that there's people buying it at that location. How could it hit a price so exactly though? Well, when you watch it live, you'll see it play out, right? When you're watching it live, you'll see that it's just sitting there and they're just going back and forth across this one price with not very much trading. What criteria? So what it does is it says if the last trade was at like 27.5 and the next trade is at 26.5 instead of 27, right? And there was only yay much that actually had traded, then it does it. So it basically like a price has to be skipped. And the whole thing is that like in the treasuries, it's going to be like, okay, well, it's going to trade like 20, it's going to trade like 200 contracts there before it trades 27. So that's what that little filter is there for. Right. So what you see on that chart, I think is pretty much exactly what I would expect, which is that like it probably only tends to happen like right after news in the treasuries. Right. So, but it's really useful in the E-mini because, you'll hear that noise and immediately go, okay, usually that's news, but something weird happened in the E-mini market. If that happens and there's not news, then maybe you could try trading around the hole. Because if I have a reason to believe that there is a hole somewhere, and we're a little bit away from it, and the hole is still there, and I don't have any reason to be expecting flows that will continue to move us away from the hole, then what's the most likely thing to happen? That we fall back into it, yeah. So I can't do it just off of the chart alone, but once I combine some informational content and stuff, then I can kind of make those judgments. Oh, so I missed something. A here said, can you give an example of a setup that you usually take? Well, so an example of a setup for me would be like Monday. So I don't think we executed this very well on Monday, but on Monday when we came in, we knew that there was a Federal Reserve meeting this week. So we said, okay, there's going to be people hedging themselves for the Federal Reserve meeting. There's also a story by Nick Timiraos suggesting that there were some people in the FOMC that were concerned about inflation still not coming back to target, that inflation could come roaring back and that they need to continue to be vigilant and so forth. Okay. And there was also an auction that day, right? So I combine all of those things together, and what I get is that there should be more selling that day. Right. So once I know what the flow is going to be, then I try and get in as early as possible in a quiet location. Right. So I kind of missed the initial move, unfortunately, and it was actually going against us at the beginning. So it was a tough trade. But eventually I did get a good spot, and it just didn't quite play the way that I wanted. So I got out of it. But, based on everything that's set up, and if I had the time and everything, because the thing is that it was actually correct trade. It's just, it took much longer than my trading session for it to play out. But it did happen. The flows for the day were overall sell. And if you had taken it, because we had basically taken it at 3.8, and they moved all the way up to like 3.89 if you had held it to the next day, right? So that's an example of that's what I use as a setup, right? I have to have some reason to think that there's going to be an imbalance in the flows. Like I'm expecting it, right? So I might not necessarily always say, oh, okay, do that calculation and I'm only going to go long, right? But I kind of know what's going on. So if I start to see an imbalance in the order flow, like the market orders are starting to go in one direction, and then I could say, okay, well, what are the things that I know that are going on, the flows that I'm expecting? Okay, well, that matches this flow that I thought might happen. And the way that the correlated assets are moving are all kind of in line with that. And then I could take it as well, right? Do you think it would be wise to trade with real money from the get-go? Like, let's say one lot on a treasury market? Okay, so it really depends on what your risk tolerance is. But if you're just starting out, so when I started, I had like $1,000 account and I was trying to trade one contract on ZN. And what I would find happen to me pretty consistently is that like eventually I would get myself into a situation where the market was moving really crazy and you could lose $500 to $1,000 in a day. So it was too much. So, probably better to go over to micros. But again, that depends on what your risk tolerance is. So if you're able to put $10,000, $20,000 into it, then you could totally pull that off, right? But for most people, probably you're better off starting with micros. And yeah, with micros, it's pretty difficult to make enough money to overcome the data fees, but you can keep trading with micros in one lot for a long time, right? Because they'll cancel each other out and you just stay even. And as long as you get to keep trading, it's cool, right? And then as you get richer, as you almost certainly will as you get older, and then you size up, right? So I am the whole thing about sizing up for me makes me a little bit nervous because every time that I try sizing up, it kind of blows up in my face. But I am starting to come into a new point. Like I said, switched jobs recently, so that gives me a little bit more discretionary income. The stream is doing really well. My performance has been acceptable. I'm running out of it. This summer it's not necessarily a good time to be trading large size, but I'm running out of excuses, right? So time will come where I'm gonna take it slow. I'll just do 2 contracts, but yeah, I'm thinking that at the end of the summer we'll probably be trading 2 contracts. And then that would overcome the problems with the data fees, right? But now the other side of this though is that when you start trading, it's almost certainly this is something where you almost always do terribly at the beginning. So keep that in mind too. It usually takes years for you to figure it out. And it's not even like so much that you like to figure it out, because I've kind of figured it out for you. Like I've kind of found like some of the key places where we have quantitative data to back up or contradict all of the mistakes that retail traders commonly make, right? So you can go forward like knowing that the stuff that you're working on is actually useful stuff and gives you a chance at least, right? It's probably still going to be the case that most people that try to do it will fail, and the people that are successful with it will take them years for them to do so. So that's why I would say that, I think it makes sense to trade sim at the very beginning, and I wouldn't be shy about trading sim for a long time, like a year or many years. Because what happens to most people is you got all these people that are like, oh, it's not the same thing because the money's not on the line and you don't have the experience in dealing with that and everything, right? And then what happens is you go and you blow the account and then you can't afford to keep trading, right? So 6K market sells on ES and isn't budget. They're going to buy that 45.85. Well, you got to remember that mine aggregates the prices a little bit, but it does seem like the E-mini is a little tight, that people are fading it and keeping the volatility down. I'm not sure if 8K is enough to create like a liquidity hole in ES. Yeah, technical analysis is non-causative, non-predictive hindsight gambles. There you go. Because you're looking at the past and you're looking for some pattern. Like, here's the thing. Is if I go and I do a statistical analysis of something, like in this situation, what happens after that situation? Okay. And 90% of the time it comes out in a certain way, right? Then there's probably something going on there. There's probably a reason why the outcome is like that. 90%, right? Okay. Now I go back and I do that again, and it's 50%. Is there something to that? Who knows? It's because, you know, there's a good chance that it's just random. So if it's 52%, you know, depending on how many samples. I mean, if you had like 1 billion samples, then maybe you had something. But, you know, if you have like 100 samples and it's 52%, like that's within the margin of error, right? And yet that's what most of technical analysis is we go in, we make a statistic, and then we just assume that that statistic is going to continue to hold when we don't really have any real clear reason as to why it would. And then the problem on top of that is that the markets react, right? Because if there is a certain tendency for it to come out, everybody knows that and adjusts their trading accordingly. That's what we're going to show in this next video, because I've hit on that in so many videos where I've tried to tell people, like, the market's competitive, so these sorts of pattern things that everybody's chasing after are not going to be consistent sources of edge for you, especially if it's something that everybody knows about. Okay. Well, how do I get people to understand that? Because when I explain it to them, I don't think it, you know, I get excuses, and it doesn't seem like they understand like the market microstructure behind it. It doesn't seem like they believe it, right? So what am I going to do? I'm going to show it happening. I'm going to show them, like, look, here's a strategy that was popular. And you can see that as it started to get a little bit popular, before it was just random. It got a little bit popular, and now the strategy is working. And then it got really popular, like it went viral on YouTube, and now all of a sudden it consistently loses. At almost the exact moment that it went viral on YouTube, it stopped working. Right? But there's an algorithm. Well, there are algorithms, but they don't work the way that people think. Like, this idea that there is an algorithm that causes the market to move up and down in some sort of certain pattern, that's nonsense. Because what is the algorithm? The algorithm, I'm trying to tell you what the algorithm is. This whole thing is, I'm telling you, here's the algorithm and how you take advantage of it. The algorithm is take up all of the liquidity in the market, and then when the market starts to show some strain, back off and wait for the liquidity to heal, and then do it again. That's the algorithm. And like the most simple personification of that would be Almgren Chris. You can go and read about it. Market orders pure souls. Well, I wouldn't say that. So I would say that the news in and of itself creates a hole, right? The news causes all of the market makers to pull their orders. And so like the news, the open, these are all things that kind of like reset everything. That's why it's, you know, you can just start from the 6:30 news and say, okay, 6:30 news is going to be a hole, and then 45 minutes after that is then when we're probably completely healed and we can do another thing. And so that's where you get these kind of times, and you'll notice that like the market has a tendency to do things at these times. So it's like, okay, 6:30 and then 7:15, right? And then 8 o'clock. Between 8 and 8:30, basically. Because that's how long it takes for the liquidity to heal. And you can get a little bit more precise about it because the decay function is a 3/4 function, right? So you can look at how big the first meta order was and how long it took and use that to predict what the decay function is going to be. But, or you can use 2/5. Or sorry. So because it's like a 3/5 law, basically it ends up being 2.5. I forget the math. I forget how you do it. It's like it's a 3/5. Is it a 3/5 or is it a 2/5? I think it's a 2/5 law, right? So then when you take the inverse of that, it's 5/5, which is 2.5. So you can basically come in and say, okay, this move took 5 minutes. So it'll take 2.5 times that. Sorry. This move took 5 minutes. So then 2.5 times that is the decay function. And then you get the next move. But that one's a secret. We don't talk about that one. Eventually it did sell off a little bit. Yeah. So now watch. Cause I'm gonna bet you, I think that there's a little bit of a range, like let's say between 45.85 and 45.82. So like if they move a little bit lower, and I would say the FOMC kind of cancels this all out, but if they move a little bit lower, and then there's a really good chance that they revisit that spot and then continue back down. Now, the temptation is to say, oh, okay, so once it starts going lower, I should buy it on the theory that it will come back to there. Well, chances are that it comes back to there, but there's fat tails, right? So really a much better trade is to let it chill out and then go short on it going further. But I would only do that if I had some reason to think that the E-mini should be selling. Okay, so the News Squawk was just saying a bunch of stuff about some military movements in the whole Ukraine-Russia thing. I didn't catch all of the details to know if it was significant. Market's not really moving. Well, I mean, the E-mini is selling on that. Let me just see here, because I guess I didn't have the Twitter page open here. Oh, a nuclear ICBM launch vehicle was spotted within a convoy moving in Moscow. Okay. I don't know if that's a big deal or not. What if it doesn't want to heal and liquidity doesn't catch up to the hole? Oh, so that could happen. So in a situation like that, though, you're probably more likely to be in an unhinged market, right? So remember that there's this whole thing with the square root law, which is like, This is the number of orders and this is the impact that it has. And as the size of the meta order gets larger, the impact starts to, it follows a square root law and starts to reach an upper limit. But there is a certain amount at which it breaks free. And then the market is unhinged. And that is the market where the limit orders just completely disappear. That's like a flash crash, right? And so to be in a situation where like the liquidity didn't heal, that's probably because you're in an unhinged market, right? So you don't place a trade unless you know what's causing the movement. Yeah. Well, I mean, I don't think that I have to explicitly know for sure, but I have to at least have a pretty good theory. I'm going to be expecting it to be coming through. So yes, if I see a move, if like the treasuries just all of a sudden jumped up to the highs and started pushing really hard on the upside, a lot of people would say, oh, I want to get long on that, right? Well, I don't know why it's doing that. If I didn't hear anything on the news squawk, then I'm kind of like, that's sketchy. Because the problem is what causes it to move? The orders. Okay, so I just saw a certain amount of orders to come through. That doesn't mean that there's going to be more orders that come through. It tells me nothing about the future orders. But if I know that those orders came through on a certain piece of news, and it was only like 1,000 contracts, and this is a piece of news that could potentially move 50,000 contracts, right? Then I have a trade. So there's kind of like two downsides to this is that number one, does end up in less trades overall, which I guess is a good thing, but it's a bad thing if you get bored, right? And sometimes you're wrong. Sometimes you just don't know what's going on. Sometimes you don't have that edge, right? So you can totally have somebody come in and try trading this way and do absolutely terribly. And then does that mean that like the things that we know about the market are wrong? No, it just means that he didn't have information that really effectively predicted orders, right? And that's a far cry from if there's a certain technical pattern that's supposed to come into the market and I trade it and it doesn't work, why didn't it work? Well, then they would say, well, because you didn't trade the pattern, it was psychology. Okay, but like, especially if I like programmed it, then why didn't it work, right? I programmed it, it didn't work because the pattern's not actually a thing, it was just noise. And you never bothered to backtest it, right? Yeah, I think that on that ICBM thing, I don't know if that's actually a big deal. I think that my news squawk just was spending a little bit of extra time to explain what it was that they saw. That this is being reported on Twitter, essentially. Well, it's time for me to get going now, so I didn't even realize I went over a little bit. But I will be back for FOMC for my lunch break. So I will see you guys then. In the meantime, stay excellent, team.